too. You know, but get down. can't get no gigs, I'll take a job. Yeah, brother, if I'm gonna get me a pocket full of jobs, so when one give out, I'm gonna have another one. So what you need? I don't need 2 jobs. You need a pocket full of jobs, man. One to eat with, the other to sleep with, and one to watch me sleep. You want to pay the taxes. Man. Can't say you don't want a job, no job, as long as the job don't job him. I want a job, before I get a job. So I can job some grits. I need the grits. Yeah, I got the grits. Want a grit? Breathe over there. Want a grit? That's the grit. Want a grit? Feed your soul. You must grit. You need grits. Want a grit? Poke and boom. Want grits.
everyone. I've got your attention. So hi everyone and welcome back. I hope you enjoyed lunch and are ready for the afternoon session. As promised, we have a great lineup today and hope you're looking forward to some discussing and networking in some more in the coming hours. This afternoon we will be looking at alternative investments, and we are really excited to bring you a special recording of the popular podcast Marine Talks Money, hosted by Marine Somerset Webb from Bloomberg Opinion. Okay, let's get started.
Please welcome to the stage GF Biochemicals co-founder and CEO Matteo Flamini with Bloomberg's Alex Webb.
Good afternoon, everyone. As you can see, I'm delighted to be joined on stage by Matteo Flamini, who you might know from his deep misfortune of having spent 7 years at Arsenal, as well as, of course, being a three-time FA Cup winner, and a Serie A winner with AC Milan. He's, of course, here in his capacity as the CEO of GF Biochemicals, biochemical company that he started while he was still a player. We will dig into that in some detail a little bit later, but one thing I'm keen to start with, perhaps, is your experience as a player sort of with money. You know, by the time you get to your late teens, you can be earning sizable wedges of cash. What sort of guidance do you get, either from the club or maybe your agent, manager, on how to deal with that capital?
So, first of all, good afternoon, everybody. We're pleased to be here. And maybe to answer your question, straightforward answer is like we didn't get, or we are not getting any advice at all. So if we go back a little bit in time, I remember, so I started my career, I was 18, started for the club of Marseille, and very quickly I moved to UK to join the club of Arsenal. And I remember being 19, 18 and a half, 19. I don't think at the age I've even like set up a bank account. Okay, and I remember someone from the club taking me to the local bank. At the time I was living in Hampstead and opening up a bank account. I didn't have any clue what was at the time interest, mortgage, and simply open a bank account in a local bank. And already at the time I was 19 and we were making a serious amount of money. So is that normal? I don't think so. I think there should be some kind of organization or maybe clubs or institutions such as the Premier League and others should support the athlete, because the reality is if you're not supported by the club, if you're not supported by the Premier League or by the largest organization, I mean, then you have to rely on maybe your family or your agent. And if you're well surrounded, this is great. I've been lucky because I was well surrounded, but if you're not like necessarily well surrounded, then you can have some trouble.
Presumably, you do start to get, inbound requests. Oh, you should invest in this, invest in that. How does that happen, and does it come through your agent, or do people just reach you by other means?
I would say this is pretty organic. Usually it comes from, yes, your agent, your surrounding, people you meet. Circumstances in life make you sometimes meet people, and then you have a certain affinity, and you can develop a business, or you can make some investment. The reality is when you're an athlete, first, you don't have too much time to play around and to go around, I would say. And two, usually what you do is like you stay in your bubble, okay, because you're playing every 3 days, and most of the time, I mean, people want a lot from you. So you stay in your bubble, and the few contacts you have with the outside world is through your agent, through your friend, and maybe your family. So most of the investment opportunity you have, they come from those entities. So again, what I was saying is like if you're well surrounded and you have people who do the job properly, then you can be successful. But if you're not, then you can be exposed, and you can make the wrong investment, and you can have a lot of trouble.
Is it something you talk about with other players? Exchange ideas. I mean, I assume so because you have an investment with Mesut Özil. What sort of conversations are they like in the cafeteria, perhaps?
We do, of course. We're trying to understand a little bit from one to another, I mean, what we're doing. But the reality is when you're an athlete, you quit school at maybe the age of 16, 17. If you're lucky, 18, maybe you do your A-level. I was lucky, I studied law. I could miss 75% of the classes. But I remember at the time asking my first club, Olympique of Marseille, if I could miss 25% of the training to go to university. Very quickly, they told me, you're being paid to play football, not to study. So the reality is like not all the athletes have I would say the knowledge of the education to understand a little bit also how to make investment. I remember also asking a friend of mine in the dressing room, how much do you pay your agent? Usually an agent can be like between 10, 15, 20%. I remember him telling me, listen, I tell him how much I would like to win and he take care of his own commission. So all this is pretty like, I would say, immature. But this is something you can expect when you have to quit school at the age of 16 to basically be fully committed in a sport you love so much.
You said did you do then presumably the first year of university in Marseille before coming to London for law? When do you really start thinking? I mean, the classic route for a footballer, at least in the UK, was you retire, you buy a pub. Alex Ferguson, I think, was being taught how to run a pub by Gordon Strachan's dad or something before he became manager of Aberdeen. When do you start really thinking about, it's quite a short career, what you're going to be doing at the end of it?
So first of all, I grew up by the sea. Okay, my dad used to be a diver, and I remember those unlimited, those long time spending on a beach collecting plastic. So from a very early age, I was very much aware of the issue related to sustainability, climate change, and the impact we could have, the negative impact we could have on nature. So for me, it became a passion. It's been a journey, of course. So my biggest passion was football, and I've been extremely lucky to live a dream. And the second passion was sustainability. So from very early age, at the age of 25, when I moved from Arsenal to AC Milan, I had the opportunity to meet with some scientists. At the time, they were ex-BASF scientists. They were also working with the Polytechnic of Milan. And again, as I was saying, circumstances, I met with the other co-founder, I met with those scientists, and we decided to start a journey. And the journey was to very much join the effort to accelerate the transition from the petrochemical industry, meaning like the chemical product based on oil, to transition to a biochemical industry, which means starting from biomass. And this has been a long journey because they have forgot to tell me that bringing a new molecule to the market, it's a journey of 10 years. If they would have told me, maybe I would have never started it. But it's been pretty interesting, I will say. And yes, we speak between the athletes about investment, and everybody is looking for answers. And it's not always easy for them to find those answers.
So your co-founder, Pasquale Granata, how did you meet him, actually?
So we meet...
I should say it's GF Biochemicals. Pasquale Granata is the G and Mathieu is the F.
Yes. So I prefer when we say that we are entrepreneurs more than investors, because we started the business and we met through friends. And like I was saying before, when you're an athlete and you play in a big clubs, you are in a bubble. And it's usually, you don't go out of that bubble very often because you're very busy with the training and you're playing every 3 days. And we met through common friends, and we had the same vision, the same, I would say, passion for sustainability, and we decided together to build this company. So it's been an exciting journey, not always easy. Because when you're an entrepreneur, every day you have good reason to stop and to move on to something different. But I think with a bit of determination, you can be successful.
Can you talk me through what your day looked like when you were training, but also an entrepreneur on the side? Like, say you don't have a match, it's not a match day, but typical Tuesday or Thursday or something. How does that day look for you?
So let's say you start the training, you meet generally around 9 o'clock. Then you get out on a pitch around 10, and then you have like 2 hours training outside, so it's very intense, focusing on intensity and speed. And then you come back, and usually you have a gym and probably some massage or some stretching. So as a football player, you can be home, you back home around like 2:30, latest 3 o'clock. So you still have enough time to challenge yourself, to focus on a different passion, to focus on a different subject. And for me, it has been a bit of an escape. Because when you're an athlete, and probably like you guys in your work, you have some up, you have some down, and when you go back home, the last thing you want to do is to bring your problem home. So when I was playing, sometimes you were injured, sometimes you were not playing. So it was for me an escape. It was helping me to first change my mind and to challenge myself also intellectually.
At that stage, I assume, I don't want to make too many assumptions, they come to you because they're like, well, he has capital, right? He can help invest in this. did they kind of get more than they bargained for?
I mean, first, this is true. I was investing the money I was making on a pitch. I was investing it in that venture. But I think at the end, it's about like complementary. It's like in a team, everybody can bring different skills. So yes, I had some capital to invest. I hope I also brought different skills than just money. But as I was saying, I think everybody has different skill, and it's about like building a complementary team. It's like, in a football team, when you have 11 players, if you put like 11 strikers, I mean, I can guarantee you will not win the game.
Are you talking about Brazil here or no? Different team. Can we maybe just explain what is levulinic acid? That is your main product. What is it? What does it do? What are its applications?
So maybe let me tell you a little bit about the petrochemical industry. So today, the petrochemical industry is everywhere. Everything you touch, everything you use, whatever you're sitting right now. So we cannot escape from the petrochemical industry, okay? This industry is generating 1/3 of the oil demand, okay? And by 2050, it will generate more oil demand than transportation, okay? So we're going through a transition, going from a petrochemical industry to a bio-based industry. And two main factors. The first one is a regulator, which is phasing out all those harmful chemicals from the consumer goods. And two are people like you, people like me, which are requesting safer and more sustainable product, okay, going from shampoo to deodorant to pen, shower gel. And basically what we are doing, we have developed a molecule platform, okay, which allowed us to do derivatives and to manufacture what we call plant-based solvent. Those plant-based solvents are being found in shampoo, deodorant, shower gel, when you turn the packaging and you see at the back the 20 to 30 like ingredients which you never understand. I mean, we are one of them. And what we do is basically we replace the harmful ingredient coming from the petrochemical industry and making the end product much more sustainable and much more like safer for people.
So what goes into it? And then ultimately furthest down the line, what are the kind of end products you are in? Shampoo one?
So we start from agriculture waste. So what's important to mention is what we call second generation feedstock, which means there is no competition with the food industry. We take this feedstock, it can be like leftover from the sugarcane, leftover from the corn cobs, and we convert that via a chemical reaction. We convert that into what we call plant-based solvent. And those plant-based solvents are being used in shampoo, in shower gel, in pens. Maybe I'll give you a few examples.
Is there a brand that I might use that you supply?
Maybe, because we work with a big FMCG company.
Can you name one or two? Or?
I'm not allowed, because usually when they find a good technology, they try to keep it very, very quiet. But maybe a few examples. I'm sure we all use shampoo, okay? And we have all heard about like silicone. So the silicone is being found in shampoo, is being found in a shower gel, is being found in a cream you put on your skin. So it's what we call a petrochemical product, come from the industry of oil. And it is not biodegradable, meaning every time you use a shampoo which has silicone in it, the silicone is going through the drain and is accumulating in the water, meaning that maybe at one point you may going to find it in the water we drink. So it's being phased out from the market 2024, 2025. So our product are a replacement of the silicone. But our product, the main difference is they are 100% biodegradable, meaning when you use them, they degrade in nature instead of contaminating. And what has been very interesting is like lately the US government has banned what we call the forever chemicals, which means chemicals which never degrade. So they have banned 6 of them, and hopefully this is going to create a momentum, and we will have more and more chemicals being phased out from the market.
It's interesting because you sort of had two fields you had to learn about. There's the kind of the business piece, but then also this sort of biochemical, biochemistry essentially. You had these perhaps 5, 6, 7 hours at the end of your day after training. How did you set about, immersing yourself in learning this stuff?
I mean, first of all, I've been a never-ending student for the past, I would say, 12 years. I'm surrounding of PhDs, I'm surrounded by engineers, technicians, and I don't have any technical background at all. As I was saying, I studied law for 6 months. I think for me, the definition of intelligence is 1, adaptability, being able to adapt, and 2, the capability to learn. And I didn't have the choice, I had to learn, and I had to learn quickly, because I became the CEO of the company a year ago, following the investment from Sofinova and Sparta, which are 2 of the very, I would say, sophisticated investors in a biotech field. And the last aspect is I've also been able to leverage some of the learnings which I've accomplished during my life of football players. And those learnings have been transferred in my life of an entrepreneur. And if you want, I can mention you a few of them.
Sure, go for it.
I mean, first of all, is perform under pressure. When you play in front of 80,000 people and many more on TV, not only you have to deal with the pressure, but you have to be good at what you do. And when you're an entrepreneur, this is the same. I was investing my own money for many, many years, and I didn't have other choice than to make it successful. This is the first aspect. The second aspect is dedication, hard work. When you play at the highest level, it's a 200% dedication. Same when you're an entrepreneur. I mean, like work day, night, and you have to keep going. As I was saying before, every day you have many reasons to stop, but you have to keep going because it's hard work. And I would say the last part is probably like team spirit, teamwork, leadership. When you're on a pitch, I mean, you're part of a team of 11 players. You cannot play on your own, and you have to put as a priority the team before yourself. I think this is exactly the same when you are in a company. I think the company comes first, and even if people make the company, this is important to work as a team and to inspire others, I think.
You mentioned you had this Series A last year. You raised 15 million euros from a few venture firms. Clearly, when they actually decide to invest, it's real money. They've got to make the right decisions. But you being you, does it help open some doors?
So, of course, I have to be honest. When you're a top athlete, it's easier to meet people, the people you really want to meet. This is one aspect. But also it can create, it can have a negative effect at the same time, because being an ex-football player and running a biotech company is not always easy. So we are not building an app, or we're not building like a website. We are in deep tech, meaning like hard capex, building a chemical plant. We're manufacturing in Asia. So when I was in discussion with Sofinova, which is, I would say, in Europe, one of the most sophisticated investors in deep tech, being obviously like an ex-football player was not, I will say, always easy to justify. And even when we had the discussion about like if I was going to run the company or not, I had to, I always believed I had to work harder than the others to justify my position, I would say. And then we went through like a long process. I think it took like maybe between 8 to 12 months in order to close this round, because I had to go through like a full audit of the companies. And for the small stories, they even organized a call with Arsene Wenger to make a due diligence on myself and check if I was like reliable, hardworking guy. So they probably checked a little bit of everying before.
You gave him a little bit of equity, and
I didn't know how to do that. Thank God.
He's got plenty of money. The way that you're sort of post-career now, there are a lot of players, presumably, particularly when you were a youth player, who weren't as good as you, or at least didn't have your success. What sort of things are they doing? Is it perhaps players who were in Ligue 2, Championship, or a little bit lower, earning decent money but not incredible money? How is that path for them? Like, do they have to think even more carefully about their money, and is it harder?
I think it's the same problem for every athlete. At the end of the day, of course, if you make more money, I mean, it can be easier to address your after career. But let's not forget that when you play, when you're an athlete, I mean, it's a short period of time. We talk about like 10, 15, 16, 17 years, if you're lucky. I think I've played like 17, 18 years. But the hardest part is how to reinvent yourself. Imagine like you're a journalist, you have been doing that all your life, and from one day to another, we tell you cannot do it anymore. You have to find something else to do. So, this transition is not always easy, because you have to first to reinvent yourself, and two, I mean, mentally, it's not always easy to find something else which you have something else to do which you have never done. This is why, I mean, most of the athletes, I will say, usually stay in a world of football. They become agents, they become managers, they become like they work on TV, because it's challenging. It's challenging for someone to reinvent himself and find himself like a new purpose, a new mission, and to learn everything from scratch.
Actually, that fundraise last year, can you talk a bit about the valuation? Was it tens of millions, hundreds of millions, higher, lower?
I mean, we're a private company, so...
Which is why I asked the question, otherwise I'd be able to see it on the stock market. Can you give a sense of the ballpark?
I mean, let's say we have invested like tens of millions over the past decade. Business is going well. We're having like agreement with large chemical company, large FMCG company. We're launching a new R&D facility in Aix-en-Provence, in the south of France, which will very much focus on bringing the new product to the market, trying to again bring solutions to a problem. I mean, we all use consumer goods, and the idea is like to make them safer and more sustainable. So things are going well, and I'm also working closely with the French government because we have the intention to develop, I would say, like a new facility potentially in Europe, and France is one of the countries which we're exploring. It's a great ecosystem right now.
One of the reasons I asked the question is I live in North London. Plenty of Arsenal fans will say, "Oh, Mathieu Flamini is the richest post-retired athlete, richer than Jordan, richer than any of these guys." Do you think you are, or do you think you will be?
I don't think I am, and I don't think this is a priority right now. I mean, unfortunately, sometimes in football, not all the journalists, I will say, have the capability to understand like the business world. So sometimes when you don't take an interview, I mean, like it's difficult to control what is being written. But I'm pleased, and today I'm sitting with journalists very knowledgeable and we understand the business world.
I think there's somewhere in this room, if not on this stage. My very final question. Prospects, Arsenal this season, are they going to do it?
This is a very good question, and since I am an Arsenal fan, obviously I think they have brought back hope with the Arsenal fan. We're all very proud again to be Arsenal fan, and I want to believe that it is possible. I mean, so far we have been doing the right things, and we know to win the Premier League, this is not a sprint, it's a marathon. We know we have another couple of games ahead of us. We have to stay focused and make sure we cross the line first.
Well, thank you so much, Mathieu, for joining us. Quick hands together for him, Mathieu Flamini.
Thank you very much. Thank you.
Please welcome to the stage Blackstone Global Head of Private Wealth Solutions, Joan Solotar, with Bloomberg's Ben Stupples.
Hello, everyone, and hello, Joan. Thank you very much for flying in from Paris. I found out to join us today via New York, of course. Yeah. I'm going to let the numbers do the introductions for you, being at Bloomberg, as we are. So your division at Blackstone, private wealth division, in 2011 had about 10 billion under management. Now you're about 239 billion, making up about a quarter of Blackstone's total AUM on the sort of race towards Steve Schwartzman's goal of 1 trillion. Now, before we dive into private markets, I want to get the big QR code up behind us so that you, our dear audience, can have a say on where you think some big returns are going to be made this year in private markets. Now, do also, as we go along, please chuck us some questions. I'll try to make this as flow as much as possible rather than save them at the end. I'll try to ask the questions as we go along. But Joan, our audience are going to have their say in a moment.
Great.
You tell us first, how is business? Your business has boomed over the last decade. Still booming? How's it going now?
Sure. Well, I'll just speak about Blackstone first, and then we can talk about private wealth. So I would say overall, there is definitely a continued secular tailwind to more allocations to private investments, and which basically just means like private equity, those are companies that are not publicly traded, private real estate, just real estate not publicly traded, and that encompasses more than 90% of investable assets in the world, so it's really most of that. And we see rising allocations, whether it's institutions or private wealth individuals. So last year, as a firm, we raised over $200 billion. Our group raised about $50 billion, and so yes, I would say our part of the world, and Blackstone in particular, continues apace.
And the range of your asset classes span credit, real estate, hedge funds as well?
Correct. So we're the largest, to level set, we're the largest investors in commercial real estate in the world. We have the largest and broadest private equity platform in the world. We're one of the larger providers of private credit, if not the largest. And we are the largest allocator to hedge funds. And then there are a lot of sub-strategies underneath, whether it's infrastructure, growth equity, life sciences, and the like.
And what's landing in your inbox right now? What are clients wanting from you?
Well, I would have had a different answer a week ago than I do today. But I'd start with when you had disruption emerge in the U.S. last week. The initial questions were very much just around Blackstone exposure, but it was de minimis. And so the conversation very quickly moved to where are opportunities, what do you think will happen in the wider world, because we see so much, and that's largely what we've been focused on. There's a big focus on private credit, a lot of inbounds on that, given that you can today initiate loans, private loans, senior, very secured, at double-digit yields, and relative to what you would find elsewhere in fixed income, much more stable and the like. So a lot of outreach on that. But I would say the conversation over the last week is much more around just what's happening in the world, implications for macroeconomy, and then subsectors and where we think opportunities will emerge.
Would love to unpack that a little bit more in a second. But first, let's get the results up from the poll. If we're able to do that, that would be fantastic. Are they not ready? If not, I can swiftly move along. Where are the best returns in private markets right now? Oh, wow. Well, I thought it was private credit number one. It's looking like a Formula One race. Neck and neck with private credit and private equity. And it's changing again. Someone is playing this. Clap louder, people. That's interesting. Well, Joan, I'm actually going to ask you.
It feels like a relay race happening here.
This really is.
I see the private credit zoomed up from behind.
And real estate's coming up from behind. Well, that's interesting. I'm going to say stop voting there, because otherwise you're going to make my questions very difficult.
No, I love this.
This is how my life has been for the last week. I'm sure yours is too.
Real-time sentiment.
Stock prices of regional banks. Joan, what do you make of, private equity, what do you make of that? Stop voting, everyone. There we go. Joan, you're going to answer that. So, I thought private credit would be number one.
That's so interesting. So I would say beyond the asset class, where you invest matters. It's moving.
Private credit is going up again.
If you go back to the founding of Blackstone, Steve Schwarzman had the idea that patient capital, so the value of compounding, and investing against the herd is how you make the most and create the most wealth. So if you look at your results, you'd probably say there are going to be a lot of opportunities in real estate, and I would agree, but where you invest matters. So when I think about our portfolios, again, I mentioned we're the largest commercial real estate investors in the world. 15 years ago, half of our portfolio was office. Today, U.S. office, traditional office, is 2%. We've completely changed our focus because we saw that the cost to maintain, refurbish going up, lease durations shrinking, just office trends generally, and focused on sectors where there was big supply-demand gap, and that remains today. So those are logistics, rental housing, data centers, offices that are built to suit for biopharmaceutical companies, and the regions that you choose, all of that matters. Investors tend to paint a broad brush, and I think often miss opportunities, number one. Number two, the value of compounding. I can't, if there's one takeaway, it's trying to time markets and trade markets. I don't believe that's how you create private wealth, just like that's not how anyone would create their own company, right? You're doing it over a series of years. That's how we're creating portfolios. That's how we're creating value. And so I think there are going to be a lot of opportunities. Private equity as well. It's deals right now very slow. I think you will see a tightening of credit. I think those that have an advantage in sourcing credit will be an advantage. Those who can do deals in scale will be an advantage. Those who, when they own the asset, have enough scale to affect change and enough know-how will be an advantage. But there too, you don't want to fall into value traps. You want to be investing in good neighborhoods where you can generate good cash flow and where the winds are at your back. So whether that's cloud computing or cybersecurity, or as I mentioned in real estate, some of the more attractive areas, data centers. I mean, there's a lot of attractive sectors, but equally important is what you're going to avoid. Private credit today probably offers one of the most attractive risk rewards you can have because, as I mentioned, these are, first of all, they're floating rate, so they reset as rates have been rising. They're the most senior secured in the capital structure with a lot of equity underneath them. And it's not often you can get double digit for something senior secured, but that's what you can get today. And that should suggest to you, if I could get double digits on senior secured, my bar for equity should be really much, much higher. And so that kind of narrows what you're interested in today on the equity side.
Right. And you used to work at First Boston, which, in a segue to sort of current turmoil in the markets, may now not spin out of Credit Suisse. You've built up relationships with family offices, private banks to sort of build out this product, along with independent wealth advisors. So you're not exposed or have minimal exposure to what's going on with Credit Suisse, for example.
Well, Credit Suisse has been actually quite a valuable distribution partner of ours, as has and continues to be, and UBS as well. Exposure, as it relates to a question, would be exposure to equity or bonds or anything of that nature, which we don't have. And the same is true for regional banks in the U.S., very de minimis. Our relationships, by and large, whether it's lines of credit or borrowing, are really with the biggest banks. But yeah, so not any negative exposure.
Not any negative
that's the question.
Exposure. And just one of the big drivers of your success has been the real estate product, BREIT.
Yes.
Huge amount, millions per quarter going in. In the last few quarters, you've had a few nervous investors wanting to take money out. How is that sort of state of play now? Yeah.
So first, I don't know that they're nervous investors, but I'll start
Correct
with.
Me, please.
Yeah. We have, and I think this is important because I think there's been a lot of hand-wringing that has existed only in the world of the press, and not all press, but a lot of the press. We have literally hundreds of thousands of investors in BREIT, and guess how many complaints we've had? 0. No client complaints. This is a very high-performing fund. So I think that's really important, just to set the stage, what's in the press and what's actually happening on the ground. But if you go back to 2021, this was an incredibly strong performing fund, and the same in 2022. A lot of holders in Asia were at the same time experiencing the Hang Seng at a low, world markets coming down, as we all know what happened in 2022. There's no capital gains tax in Asia, and there were margin calls happening. And so the only asset, or one of the only assets in the portfolio that still had a gain, was BREIT. And so we started seeing outflows. And then news articles started writing about it, then we started getting questions, blah, blah, blah. But I think in a world, what's changed over the last week in conversation, we don't take deposits. Our structures are meant so that we are never forced to sell assets. And the appreciation for those caps on liquidity today is far greater than it was. And so, we work with our biggest distribution partners, private wealth firms, private banks, when we're thinking about new products. And what we're hearing today is we're fine with even less liquidity. So I think that rhetoric will change coming out of what you're seeing today, which is a very different crisis. And it's really a crisis of confidence and a crisis of liquidity. And having structures in place that do not mismatch. So if you want to own buildings, if you want to own companies, you shouldn't be looking for daily liquidity. as I mentioned. And I'll make one other comment about BREIT because I think this is so fascinating. When we talk about not market timing, you could be the worst market timer in the world. If you had bought BREIT any time in its entire almost 7-year history, held it for a year, even if you sold it at the worst possible moment, which would have been April of 2020, because we marked the portfolio down in the middle of COVID, you still would have made profit. So I think, thinking about it as a monthly product, a trading product, it's not the way it should be bought, and generally it's not the way that it was bought. And I would also say, as a percentage of the total portfolio, the percentage of clients who've been redeeming is actually pretty small. So we're very happy with the structure. It's the right structure for that kind of asset. And at the end of the day, when you perform well, why do people invest? They invest to make money. And when you make it money for investors, they give you more money to manage. And that's what we've found over our entire history. Through every up and down cycle, because we do outperform, we tend to gain share. And I would also say, and this is so critical, of course, this matters whether you're an institution or a private wealth individual. The firm that is investing your money, that is managing your assets, that is so important. But it is even more important on the private side. If you look at how private equity, private credit, private real estate firms perform, there's a wide spread between the top quartile and the bottom. When you look at public equities and fixed income, it's pretty narrow. So yes, you can make a wrong decision, but they tend to kind of cluster. And sometimes you get enamored by the shiny new toy. And I would just suggest that's probably not a great idea. That if you're investing in any of these categories, you want to be with a firm that has managed these assets through many, many cycles. These are not like buying stocks and bonds.
Just one final quick question on BREIT. How long will it take to clear that redemption backlog? Next quarter? Or?
I don't really know. I'm not in the prediction business, and I don't want to predict what investors will do on any monthly basis. I would say that in prior months we've seen a steady decline. Whether that changes in some interim period, if people are nervous, not nervous about the world, I don't really know. I wouldn't want to predict. But what I will say is that it will not affect the performance of the fund, and to me that's really the most critical.
Let's move to the question we've got from the audience. What is your secret sauce, Joan? Other people have failed and actually are still at the same time building up teams in this area. You've got KKR sort of built up a sort of private wealth team. What makes you special?
Oh, what a nice question. What makes you special? I think there is no secret sauce. I think it is that we were dedicated to the channel, that we viewed it as something more than just transactional. And I think most importantly, so when I was asked, I've been at the firm 16 years, but I've been running this business for 7. And probably the biggest change that I made was moving it from a sales organization to a private wealth organization that partners with private banks, big global banks, and the like. And what does that mean? It means that we have everything from the product creation to education, which is so important, to salespeople, to investor services at the back end, and we run that fully integrated. And as I said, it's not interesting for me to have a transaction and, oh, what can I do to sell the product? No, like if we're operating in France, we have French speakers, French marketing materials, we are local, we're there for the long term. I always had the mindset that it's very much the way Steve Schwarzman created Blackstone. That's how we thought of our business. It's over years. And I've been asked for many years, how come your competitors aren't in? And I would say they will be. But we have a long history of being able to create businesses that don't yet exist, scaling them to being the best in the business. It's what we've done with every one of our platforms. Most people don't have that. And I would say, to me, the term white space just means don't have. So when I hear others saying, you know, we have white space here, that just means you don't have it and you don't have presence. We always expected that we would have competitors, and we will, and we should. Individuals are so underallocated to private investments relative to institutions and relative to what their portfolios should be, just based on less volatility, higher returns. These should be core allocations in portfolios. That's what we hear from advisors. That's what we hear from chief investment officers. I was at a breakfast this morning where our distribution partners said somewhere between 5 and 15% is where folks should be, and generally they're far less than that. So we will have more competitors. We are not alone, but I think it's this commitment to excellence. I think it's always being transparent, honest, building all of our funds off of the backs of good performance in all these categories. So having the same real estate team that invests institutionally, invests for private wealth. These are just all of the things that we've brought to the private wealth market, and I think we've just had a real consistency. And just one more, which is we have the dedication of Steve Schwarzman, our CEO, of John Gray, our president, of our investing professionals. They are willing to go anywhere, anytime, and meet with investors. And so it's the product, it's the team, it's service, it's the dedication of the firm. And finally, I think it's just the trust and the brand in Blackstone. There's a reason that we are the reference institution for the biggest institutions in the world. And I believe that we are becoming that for the private wealth market.
We just have half a minute left. I want to
my
say
gosh,
that time's flown. You've grown from about 160, I think, at the end of 2021 to about more than 300 now. Where do you see yourself growing globally?
Oh, I don't know, but I do see there's another question on real estate, so I want to just take that. We are the biggest commercial real estate investors. The biggest issue today is everyone is painting it all with a broad brush. So I do think traditional office is much worse in the US than people think. And I think a lot of firms have not been aggressive enough on their marks. We tend to be quite conservative. That's why the portfolio went from 50% office to 2%. But commercial real estate in warehouses, like I would say in the UK, releasing spreads above 50%. In the US, it's the same. Data centers, we will be talking about this for the next 10 years. They cost $1 billion to $2 billion to build. We've already built out the platform, the land, the connectivity to the electric grid. I do not believe anyone will be able to compete with us at that kind of scale. Rental housing, big disconnect between supply and the demand. These are the things that are most important, and having the capital structures to endure, which we do. So we feel great about our real estate portfolio. That does not mean we do not think that there will be pain. The companies that own traditional office, companies that own malls, this will be a very painful environment for them.
Jane, thank you very much.
Thank you.
Please welcome to the stage Sotheby's Europe Chairman Oliver Barker, Deloitte Global Art and Finance Coordinator Adriano Piccinati di Torcello, and Collection Pictet Head of Arts and Chief Curator Loa Hagen Pictet, with Bloomberg's James Tarmy.
So I think the panelists here have already been introduced, but I'm thrilled to have three experts in the field who are coming at art and the art market from three very different perspectives. We have Loa Hagen Pictet, who is the chief curator of the Collection Pictet. We have Oliver Barker, who is chairman of Sotheby's Europe. and we have Adriano Piccinatti di Torcello, who is the Global Art and Finance Coordinator for Deloitte. And as a matter of brief housekeeping, the term art is a very broad one. And for our purposes, when we talk about art today, we're going to be referring primarily to 20th and 21st century artworks, as opposed to, antiquities or whatever, because already that's a pretty broad field. So I think it makes sense to begin with a pretty fundamental question, which is nevertheless something which I think all three of you, and I think many of the people here, are interested in, which is whether or not art is an asset and whether or not it's a good one. And Adriano, I think given that you are approaching this from a kind of broader analytical perspective, I'd love to hear from you about that first.
Okay, I'm the one to shoot first. Perfect. So first of all, I would like to thank Bloomberg for inviting me, so thank you very much. Pleasure of being with you. First, on the Deloitte side, we don't do any investment recommendations, so we are not investors, so I prefer just to clarify that point right from the beginning. So there's maybe 3 points that I would like to mention when we talk about art and collectibles. In fact, so this is a kind of extremely important quantity of wealth. So we have estimated in our last Art and Finance report that ultra-high net worth individuals have allocated wealth to art and collectible in the range of 1.5 trillion of assets. So if you compare that to the alternative asset or private markets, so is it 11 trillion, 7.5 trillion, so don't really matter, but it's quite substantial, meaning that if tomorrow we can incorporate that into private markets, it's substantial. So definitely it's an asset. Is it an asset class? So to be seen. So, but first of all, before I discuss more that point, and I'll try to be brief, I know that we want to have a discussion. For the first recommendations that we say is that, and this was mentioned during one of the panels before, first we have to talk about conservations of wealth. And I think it's important to keep that in mind. So there's a lot of money allocated to art for various reasons. Is it emotion, passion, investments, whatever. But definitely, so on the wealth management side, I think there is an opportunity, but also a fiduciary responsibility to incorporate the wealth that is allocated to art and collectible in wealth management services to protect, to monetize, but also to discuss legacy philanthropy. So this is not at all about investment. Now, and sorry, so I'm a bit long. So coming back to purely the questions of, is it an investment asset class? So if we look at the characteristics of art, so negative cash flow, there's a kind of a negative beta for the art in general that offer a little bit of diversification, huge cost, quite illiquid market, but also you have tax, you have possibility to lend against that, so you have philanthropic questions. So definitely I think it needs to be treated as an asset, and we tend to treat it as a capital asset. And my last comment, sorry again, so I think what is interesting to see nowadays is all the development around fractional ownership, and maybe we will talk about that a bit later, and that maybe can solve some of the issues that are when you deal with art as an asset class. And I'll stop there.
I return to this fundamental idea, though, is it a good one, right? It is obviously a tool. It's obviously a tool that very wealthy people use both for estate planning, tax planning, and so forth. Are the returns comparable to putting it into an index fund? And that is, I think, a very, very important question. Oliver, when people are coming to you, do you see people considering, collectors, both buyers and sellers, considering art within that framework? Or
I think it's a really interesting question, this. I think the short answer is that nobody wants to buy expensive art or collectibles without having a sense, or at least a hope, that as an asset appreciation, they will start to go up over time. And I think that the only way to really measure this is through repeat sales of either comparable objects or similar objects by the same artist, for example. So something that we've actually done is start to build out the data around this space in particular, and we've got an ownership of the Mimosis Index. And what we've found is that since the mid-1950s, art has been going up at a rate of about 8.5% annually. So if you want to look at it from that perspective, yes, it does look very favorable against other kind of investment assets. The one thing I would say, and following on from what Adriano just mentioned, is it's not an ideal asset though, because if you have to pay for conservation, or if you have to pay for condition and physical work, restoration, that type of thing, it's illiquid. I mean, there are so many elements which a share does not have, and and equally, it's not terribly sellable. I mean, to sell a very expensive work of art in pretty much any category requires a moment of kind of refreshing that asset. It's a bit like selling a house again in a very desirable part of whichever town you're looking at. So in that respect, it's not one to be taken lightly. And certainly, in the course of my career, I've been at Sotheby's nearly 30 years, we never talked about art as an asset class, over 20 years ago. Now it's very different. I mean, as I say, we've become a lot smarter, I think, in terms of kind of looking at assets through data. But equally, the services that we offer our clients, for example, we have a very good lending business, Sotheby's Financial Services, and we're super comfortable lending money against art. So in that regard, it definitely is an asset as well.
When did that change? When did you start talking about art as an investment?
I think, well, I mean, we have tried hard on occasion to actually kind of see how flexible the market really is. And, and again, there have been multiple kind of financial crises over the last sort of 10 or 15 years, and we may be on the, the precipice of, or in one now as well. But every time that the market's been stress tested, and if you look at things like the big Damien Hirst sale, the famous Damien Hirst sale, which was on the 8th of September 2015, literally the weekend after kind of the major Lehman Brothers collapse, it passed with flying colours. I mean, arguably, actually, there was a run from the markets directly into Damien Hirst. So if ever you wanted a demonstrative example, I think that's it right there. Really.
It's very interesting because obviously you're coming at this from a largely secondary market perspective. Loa, you have a relationship to the secondary market. Obviously, you buy at auction occasionally, but also it's my understanding that there's a lot of patronage and some commissioning and a lot of more kind of primary market participation on your end. Are you thinking of these works, even if you're not necessarily buying them to sell them, through the lens of value?
Thank you. Yes, I think we are a collection that purchase, we do not sell. We do not either as a company, as a financial company, give advice to clients. But of course we are aware that there is an asset and it's something we keep. We do not buy with the idea that it has to increase in value. But of course it's nice, and it sometimes helps to increase the budgets to show that artworks can increase value considerably. You can make money on the art market, but we do not treat it as an asset as such, and we do not advise neither in that sense.
It's very interesting, though, insofar as you're coming to the market as a collector, effectively, but you're coming to the market as a collector, but also as a financial institution. Presumably a financial institution that doesn't want to overpay or necessarily purchase something that's not going to be valued, if not monetarily, culturally speaking, or whatever. Are there criteria that you use to approach works both new and slightly older?
I think it's hard to set up criteria as each artwork, but for sure we work with some artworks. If we go out and do important acquisitions, we tend to have a good strong feeling that they have a staying power, they have a capacity of becoming a cultural patrimony that we'll be proud of in the next 200 years. That's our idea. We're there for the long run, for the long-term thinking. And for us, it's always the question of accessing the best works by the best artists. All artists do minor works, and it's always a question of how do we access the best works. And actually not selling artworks is important for the credibility and the trust that we build up with the artists, the dealers, the galleries, and even with the auction houses.
I think it's that very notion of approaching it with a sense of longevity that a lot of people, perhaps people in this room as well, are particularly interested in. There's the saying, past performance is no indicator of future results. It's very hard to determine past performance, given that so many artworks simply sink rather than come back to the market and fail. And please correct me if you guys feel otherwise. Adriano, when you are trying to analyze the market, because there's such a paucity of real material empirical data, how do you actually look at results in a way that you're able to give recommendations?
So, and again, so we are not making any investment recommendations.
Not recommendations, not recommendations.
So we tend to use definitely academic studies. We use also the indices that are published by various providers, including the one of Sotheby's, May Moses. But what I think is very important, if you look at those indices, is to understand what kind of methodology has been used, what kind of segment of the art market we are talking about. So is it contemporary? And if it's contemporary, are we talking about blue chip, middle market, low end of the market? So that's making huge differences. Something that I think it's interesting to note is that it is one paper that has been done by two professors, one from London School of Economics and one from Paris, I should say Paris. And the long-term real performance of a blended and all art kind of index is 2.4%. And I think that's kind of an interesting, because it's 100 years old kind of performance, tracking the real return above inflation. And this is why I think, so when you look at all those kind of indices, what is interesting is to understand that if you buy well, if you, of course, hold well your asset, this is very important, so it can increase in value. So now our philosophy is more to say, in general, if you buy it for a collection, so it's more kind of a capital asset. Again, so when we deal with all the cost, it's much more difficult to create an investment portfolio when you just buy the physical art object. But we can discuss about investment funds, total expense ratio, and all those type of things. And we don't have many real cases that have worked properly on that.
Well, I'd like to actually latch onto that notion of funds, not necessarily, we don't need to name names, but this idea of treating art purely as a financial instrument. It seems like there's a crop of funds that are either known or somewhat under the radar that are all trying to position themselves as real movers. I'm curious, and I don't want to throw this to one person in particular, but I'm curious if any of you would like to expand on this idea of the success or lack of success inherent in really just trying to purely invest in art rather than to collect in it.
I mean, from my perspective, as you say, some of these institutions are our clients, so they are obviously kind of important people to us. But you know, and there is anecdotal evidence out there in the arts press, and you know, recently there was an article on Masterworks, for example, in the Art News, for example. I think the answer to the question is it's too early to see whether kind of the return on investment is actually going to be significant. I think particularly in the case of Masterworks, it was formed by Scott Lynn, I believe, in 2019. They went on a major kind of fundraising in 2020. And then they entered the market very aggressively last year, 2021 and 2022 as well. So I think they're very much in kind of the acquisition phase at the moment. Having said that, the idea with them and others is that an investor can take a fractional ownership in an artwork. Now, in many ways, it's good if you don't have the funds necessarily to buy a $25 million Basquiat. The imperfect side of it is that you don't get to live and enjoy that work. And I think the point made earlier about passion and enjoyment is really one not to be taken lightly. I think that, you know, when it comes to art, historically, obviously, having great art on your wall was really a passion play as opposed to kind of just a financial investment kind of play. But it's changing. And I think also the amount of information that is out there to prospective investors too is changing as well. But it's interesting how the approach of companies like Masterworks really reflect more a investment sort of broker type approach than it does, you know, an aesthetic approach. I mean, I think investors are very much looking to Masterworks and their advisors kind of to do that due diligence ultimately. But I haven't yet seen one painting that's been sort of sold privately since acquisition by a fund like that for a major profit.
Interesting.
And if I may add on this one, because I think you mentioned Masterwork, but what is interesting nowadays is that so the idea of fractional ownership through a funds or through a club deals is not that really new. So what I think is quite interesting in 2023 is these discussions of having platforms that are regulated by a financial regulator. And what is kind of very new is that in 2023, so we have seen some financial regulators being in Germany, being in Liechtenstein, in the UK, in Swiss, granting license of a stock market, being blockchain tokenized kind of developments or more classic MTF, multilateral trading facility, getting the license. And this is kind of a very novelty in the collectible market. And I think this is something that really, I think we need to watch, and it's not just about art and collectible. This also applies to music rights, real estate, and this is a kind of an interesting momentum. And of course, so the big questions for Masterworks and for the others is what is the price that you pay for those works initially? So obviously, if you pay the high price, it's going to be difficult to realize a capital gain at the end. So I think that's critical. So definitely a space to watch, and this is something that we will cover in our next Art and Finance report in details.
I just have a quick question. Have you experienced over time, I know there's new funds coming in, but there have been funds in the past, art funds. I have never met and heard of an art fund that actually really managed to live up to its ambition.
Yeah, I think it's a really interesting point again. I mean, it depends, I think, a little bit in terms of where the fund actually is focused. And I think that arguably if you sort of have a group of investors who put together a fund, say, in old master paintings, it's arguably going to be more of a kind of flat line in terms of kind of long-term performance, unless it's peppered with major works by Rembrandt, or, you know, which are always, I guess, in any market, you have those one or two objects which kind of outperform, you know, the broader base. I think in contemporary art, again, it's been flawed with many complications. And I think, you know, access is one. I think the advisors are another one, because I think the advisors clearly have a vested interest too in terms of either stock that they have direct access to, or perhaps through gallerists and others who, you know, they have access to. But I think, again, it's this fractional element. I think one of the reasons the funds haven't necessarily or always worked is simply because, you know, people want to enjoy the picture at home on the wall, and they can't. You know, when it's owned by a kind of, you know, a broader body of collectors, it has to stay normally in a kind of free fall or something.
But sorry, but maybe also because there is this tendency, well, the art market has its hype, it's a market of influence, and as such, people who invest to follow the hype sometimes tend to not catch it at the right time,
yeah.
and actually only very few people are capable of doing that, I think.
No, I think it's an excellent point. I mean, I think certainly when you talk about what we call the wet paint end of the market, you know, the super young contemporary artists, I think that, you know, the reason the primary galleries are so important is because they actually act it's an incubator in a way for young artists as they come out of art school and as they kind of go into their first Biennale exhibition or indeed their first museum show. But, you know, there is a huge amount of speculation, it's very fair to say, on kind of younger artists. And even yesterday I met with somebody who is very well invested in kind of young painters and talks about them as almost as if they are financial assets ultimately. Now, this person claimed that he wasn't selling these pictures, you know, and obviously there's the danger if you're known as somebody who does sell works that you're not going to get access to them, you know, and access and sourcing is core to what we're really talking about as well. But, you know, the market, as we know it, certainly for younger artists, and particularly now with the growth of things like art fairs, all the galleries are back up and running. Independent artists are often working on things like, you know, social media and other areas and selling works direct from source. You know, it's much easier to speculate, particularly with the younger artists.
Yeah, I mean, I think something that everyone here has sort of alluded to is that some art is, or most art is very easy to buy, but most art is also a little bit more difficult to sell. One thing that I've noticed is that all of these funds and various schemes for investing in art tend to occur when money is cheap and people have a lot of it and they're willing to shave off a slice of their portfolio or their disposable income to whatever extent to kind of try out this sort of investment. Money is no longer cheap, and we're increasingly in an environment where people either perceive that they have less of it or actually do have considerably less of it. Obviously, no one here has a crystal ball, and obviously no one here is giving investment advice. But as we begin to look forward into 2023 and perhaps even beyond, I'm very curious what each of you thinks that people who are perhaps not nearly as tapped in, and it's hard to be as tapped in as all three of you, what people are going to be seeing from the art market, whether it's a flight to kind of older blue chip assets, whether it's a real doubling down on younger artists because that's easier to acquire. I mean, I don't know the answer. And so, Lo, I'd actually like to start with you.
Yeah, I think there will always be this curiosity for the young artist. What is the new? What is going on out there? Who is the new ones we need to get on board? I think the middle segment will obviously suffer a lot. From my perspective as a collector, I look forward to maybe seeing some great works come out again, maybe on auction or on sale elsewhere, because maybe we can access works. There's always these circular moments, but of course we're very concerned with the fact that the artists will also suffer. The investment overall are going down in many places. So for us, it's important to commission and to stay ethical, and as much as we can to support the primary market, though we catch up on the secondary market as we have a collection that runs over 200 years, 200, almost 20 years existence of the bank.
Interesting. You know, and Oliver, I'd love to hear about this from you, but also just to stay there for a moment, the middle market you're saying you think is going to suffer. Can you define what middle market is in terms of?
Yes, I think that galleries, that when artworks go up above 10,000 pounds or Swiss francs or euros, then they start to become. People think twice. You invest. But there's a lot of artists out there. The market is big. A lot of artists have been showed in exhibitions. They have a certain place, but they are not perhaps very solidly implanted and internationally well famous. And that is where people will have second doubts and generally feel they will be careful and go for those where we have a sense of certainty that these are the artists that will stay and we feel that we're on solid ground.
That's very interesting. What are your thoughts?
Well, we recently actually commissioned a market insight report actually with Art Tactic, who are very much kind of one of the leading sort of data analytic companies in this space. And what we we opened up our private sales as well, which is a big part of what we do, transactions and what we do. So, and those are figures that are normally kind of not transparent at all, actually. So what we've proven actually, the report really looked at sales from 2018 to today, and very specifically in the space that we're talking about, impressionist modeling, contemporary art mostly, some Chinese objects. And what we realize is that, by far the greater income revenue of our company, and probably likewise of some of our closest competitors, is made up of lots individually valued at $1 million and above. And what's clear is that since COVID and since 2018, the number of lots with an individual value of $1 million is climbing. And not only that, actually, the individual lots that are selling for much more than that, the super high deluxe part of the market has grown exponentially, even in the last kind of 6 months. And in fact, even 2 weeks ago, in London, we sold 5 pictures over £15 million each. Now, when you consider that there are probably globally about, less than 2,000 objects that we sell for over $1 million, that's a pretty high proportion in a very short period of time. So I'm actually feeling very optimistic. I mean, I think that often at the very high end, art is an asset class that people turn to, particularly in an environment of high interest rates, particularly if these are kind of wealthy families who are prepared to hold. I mean, I think this is very much a longer term strategy in a way, and it's not kind of something to kind of turn around and sell quickly. Having said that, we also sell a lot of kind of the younger artists, as I previously mentioned, and the buyer base of those is very much kind of Gen X and increasingly Asian markets as well. So, the Asian collector base is very active. I think it accounted for over 30% of our global buyer base last year, and particularly in this $1 million plus grouping that I was talking about. And they follow this market very, very closely as well. So, I see optimism, but you've got to be well advised at the same time.
I read the Art Tactic report. Bloomberg has written about it. You can read it. What was fascinating about it, among other things, was the fact that expensive art is getting more expensive. And it seems like there's a real trajectory there. And that is also, as you say, where the majority of your actual revenue comes from. That said, it only represents 4% or something along those lines of what you guys are actually selling. What about the other 96% of the market that the majority of people are participating in?
It's interesting. I mean, I talked earlier about the lending business, Sotheby's Financial Services. And the key part of that business, which is very much a big growth area for us, is that we're comfortable in lending to over 70 different categories of art. And we're prepared to give loans of up to $200 million on a group of objects, obviously, that we hold as collateral. And the great advantage that we have is that we actually borrow against or lend against the objects as opposed to the borrower. But the reason I'm answering to that particular question like this is really to kind of demonstrate that this market is very broad. You're absolutely right. By far the greater part of what we're selling is the lesser value, or maybe the mid market that we just talked about. But the mid market in one market is a very different category in something else. I mean, you could look at the memorabilia market or the wine market and say that £10,000 or whatever, or Swiss francs, euros, could buy the most exceptional wine. So it doesn't necessarily mean that qualitatively it's less important.
Interesting. Before we get to you, Adriano, a kind of question for the audience is whether or not all of you are considering investing in art this year. And so I believe there's a QR code, which I think we'd be very interested to hear from. But in the meantime, while people respond, Adriano,
my take on this. Yeah. So, of course, as we discussed, so there are different kind of segments, and if we would like to make a kind of a comparison with equity market, emerging artists could be compared to more emerging companies, or of course established artists, blue chip artists offer more security. What is interesting, and I've done this kind of analysis for another presentation, I've looked at the last, in 2011, what was the kind of average price for the most expensive artworks sold at auction? And I think under your guidance, but I think we were around 50 to 60 million or something like that. So now if you look at 2022, so we are more closer to 200 million. Of course, this is kind of iconic art object, which clearly see that when you are talking about iconic art objects with great provenance, so it will fetch high prices. So there's a catch for these treasure assets. The world is populated with a lot of wealthy individuals, and they want to get those kind of treasure assets. So I think that's maybe an auto-concluding remark.
I think that's a really nice way to end this. And just in terms of, I don't know, yes, we can see it here. It seems that the audience is a little bit split, which I think is a sign that we have done a very good job of talking about the nuances of it, right? No one is a mindless cheerleader, but also obviously you all are very, not necessarily invested, but engaged in the market itself. Okay, well, yes, we're leading yes, so that's to some degree a success in some regard. I cannot thank you all for taking the time to share your thoughts with us, to speak with us. Really, it is such a pleasure, and I hope everyone here has come away learning a bit more about the art market, and perhaps with some materially useful information that they can bring to the auctions or the galleries going forward. So please join me in thanking all three panelists. And yes, what a talk.
Silicon Valley Bank. There's a good chance that before March you'd never even heard of it. So why is the collapse of the US's 16th largest bank such a big deal, and why is the government stepping in to save it? It comes down to three words: massive counterparty risk. Let me explain. You see, while small in relative terms, Silicon Valley Bank was hugely popular among startups, and startups are a huge engine of global growth. The global startup economy had created nearly $3 trillion in value before the pandemic, equivalent to the GDP of a G7 economy. Venture capital-backed companies employ 3.8 million people in the US alone. A disproportionate number of those companies banked with SVB, startups backed by giants of the venture world such as Andreessen Horowitz and Sequoia Capital. Banking there was almost a badge of honor that you had made it in startup land. In fact, almost half of all venture-backed technology and healthcare companies that went public last year did business with SVB. In other words, like when you have just one bridge to cross a river, it had become a single point of failure, or the aforementioned massive counterparty risk. So that's why when it started to look like SVB might not have enough money to cover all of its customers' deposits, there was such a panic. If startups can't access their capital, they can't pay their employees, server costs, or rent. This wasn't just about a small regional bank. It looked like an engine of the tech economy might be about to break down.
Please welcome to the stage EQT Partners Deputy Head of EQT Growth Advisory Team, Carolina Brocado. Impact X Capital Partners CEO and founding member Eric Collins. Blue Box Asset Management co-founder and portfolio manager William De Gale. And Plural co-founder and Wise co-founder Taavet Hinrikus with Bloomberg's Tom McKenzie.
Okay, thank you all for joining us on stage. So the topic, the headline for our conversation is the impact of inflation across the tech sector. We've kind of had a reminder of that today. We have the Federal Reserve coming out with their latest rate decision later today. They're expected to raise interest rates once again by about a quarter of a point, about 25 basis points. The Bank of England as well, they're up tomorrow. And we had a reminder of the inflation impact here in the UK, double digits again and well above the estimates. And then you had the European Central Bank Governor, Madame Lagarde, talking today about the need to get inflation back down to 2%. Inflation, of course, tying into this higher rates environment, and that, of course, has impacted funding across the tech sector. So just how bad has it been as you've all wrestled, and your portfolio companies and your LPs have all wrestled with this record high, historically high inflation? Maybe I'll start with you, Carolina.
Of course, and thank you for having me. I would break that down into two different challenges. I think, of course, the first one is, which is probably the longer term one, which is the operating environment is much more hostile than it had been for a lot of time. For a lot of time, especially for tech and growth businesses, capital had been cheap and abundant, and so you could take risks, and you could fail, and you could try again, and you could expand, and you could take share. And you could throw money at inefficiencies, and now the environment obviously requires a different kind of muscle and a different kind of strategy, whether that's increasing prices, whether that's being leaner, whether that's guiding more towards profitability, all of the above, et cetera. So I think that's been on the operating front. It's just a different environment to operate in. And the second one is, of course, the impact that interest rates have on valuations, which is a bit of a simple corporate finance economics problem, that when interest rates rise, forward multiples decline. And that, of course, has had a big impact on companies' appetite to come to market. And if they do come to market, of course, the valuation shift that has happened from 2020, 2021 into 22 and today.
Eric, does that echo with what you've seen? Your Series A, you're an early seed plus investor. Does it mirror what you're seeing across your portfolio?
It actually does, and I was glad when Carolina made those statements. And again, thank you for having me. It's good to be here. When I think about some of the other dynamics that are occurring within our portfolio that we see a bit more widely, is that because of something like, and it was mentioned in that last little quick bit, that because Silicon Valley Bank is gone, or it's gone in the form that we're used to seeing it, it also creates a dynamic where we're finding that institutions that we were able to rely on, who did things differently than high street banks, that were able to look at risk a little bit differently, who are able to partner with us around venture debt and other sorts of things, if they're being removed from the market, we're finding that this environment, which is a challenging environment for most of our entrepreneurs, who are young entrepreneurs who've never been through a cycle and sort of seen a down cycle, they've only seen a cycle where there's been lots of money and it's been very cheap. Those individuals and those organizations don't have one of the biggest institutions that was actually established to help them to actually get through these sorts of times. So this is sort of a 1, 2, 3 whammy for them. I am optimistic, though, because what I do believe comes from this is we get some working out of some business models that aren't that interesting. They were able to be funded because of cheap capital, and that those sorts of things that maybe too many social media networks, too many whatever it is, that those things actually that didn't have great business models, we'll see that there'll be some pullback in terms of the allocation of capital to them, and maybe we'll be looking at more established and interesting portfolio kinds of company and business models, which then says what we see in the UK and Europe becomes a bit more interesting, since there is less of that sort of hype culture that's associated with businesses, and the kinds of business models are looking a bit more at revenue generation. They're looking a bit more at sophisticated business models that are able to scale with the infusion of capital. So in some ways, I'm pretty optimistic at this point that inflation is helping to clear the decks.
Okay, well, that's really, really fascinating. We're going to get to Silicon Valley Bank, of course. We'll get more of your views on that in just in the next few minutes. But I want to stay with the current topic. And it was interesting you said maybe clearing out some of the dead wood. Maybe there's a little bit more resilience here in Europe in terms of the tech sector. And maybe some of that resilience is already ingrained in those business models. Taavet, given that you were a founder, of course, of Wise, now you're running and a partner, a co-founder in Plural, your own VC platform. What's your take on what's happening? Is there a necessary clear out that's happening? How resilient is the tech space at this point?
I mean, I think in broad terms, we have gone from an environment of abundance to an environment of scarcity. And it starts at the kind of the top of the funnel, which is with LPs and venture funds. So I'm confident that we will see a bunch of venture funds that will be unable to raise their next funds, and we'll see less capital being available to the venture firms, which means there's going to be less capital available for companies. So I think it's going to trickle through all the way through the chain. But I do think that in the light of this, I'm very optimistic. I don't think creativity and entrepreneurship has gone anywhere. And as a matter of fact, we will look back and most likely say that in 2020 and 2019, companies were getting funded too easily. If you kind of think about it, maybe especially as a result of COVID, when there was a lot of basically shotgun weddings, you met an entrepreneur over a Zoom call for 45 minutes, and then after that there was an auction, and they had 4 offers to raise money from, and nobody had met these people. There was like no time to do due diligence, which is very weird, and I think we're seeing the results of that now. So we're probably going to be back at a world which is more normal. We have time to meet the founders, get to know them. We have time to do due diligence, and we've probably seen some of the big failures of due diligence also. So I think we'll be able to back a lot more companies that are much more serious about what they're doing. And I think specifically, if you think about, I would maybe highlight 2 areas where there's a giant pull right now. One is climate. If you think about the overall energy transition theme and the amount of new technology that has to be deployed to make this happen, it's going to be a huge pull. And similarly, I think the other pull is going to be everything around AI. Yes, we can chat with ChatGPT and make fun of it, but if you think about productivity improvements this will have across so many sectors, it's going to be a massive pull.
Okay, and we want to come back to that point as well. William, let's bring you in at this point. Do you share this relative optimism that we're hearing?
Well, I'm certainly relatively optimistic. I think we're very much at the opposite end of the market, though. So the companies that we're investing in are very, very big public companies, huge. And that problem for years hasn't been getting hold of cash. It's what on earth you do with all this cash they generate. So they're very free cash flow positive. They're very profitable. And they generally have substantial pricing power. So an inflationary environment isn't sort of life-threatening because they just need to do their best in that environment. And I think where some of the very big companies are laying off headcount, that actually is creating the seeds of the next round of disruption, because those people aren't being, if Meta lays off people here, they're not going to be hired by Alphabet because Alphabet laid off the week before. Those people are now in their garages and kitchens working out what the next round of disruption is going to be. So it's a long time before that makes its way to me, but it goes through you 3 first, as it were, and you digest it, take your cut, and then I buy it when it's big. So each period of difficulty creates the seeds of the next upside. And it's healthy, really. And getting rid of the dead wood is an excellent.
Silicon Valley Bank, then, and we'll go there, because we've had Silvergate, Signature, Silicon Valley Bank, First Republic is teetering on the edge, Credit Suisse, of course, taken over by UBS, which was momentous in its own right. So I'll start with a tough question. Who here had exposure to SVB?
Okay. In our portfolio, we did.
In your portfolio, you did.
Yes.
And how have you managed those risks? So as HSBC took over the UK part of the business, does that mean you were left relatively unscathed? And to what extent have you been diversifying your deposits and your bank accounts?
I think in the end of the day, so we, as a fund, we were not, well, actually we did bank with SVB as a fund, but that exposure was limited. But in the portfolio, there was lots of exposure. But what we're doing about it now, I mean, I think it just goes back to the basics of what maybe we should have been all thinking about a bit more. Don't rely on a single vendor. Like when running a business, you never want to be only on one vendor. So same applies to your banking. You need to have multiple bank accounts. You need to think a little bit about how much you keep or what liquidity you need. Yeah, I don't think you can get rid of this risk, but whether you go into the systemically important banks or just diversify across a few, I think that's kind of it's pretty sane advice, which I think as individuals we have thought about at different times in life, and as companies we just need to just be a little bit more diligent about.
Because again, it ties to the inflation question. The reason the deposits fled was because higher rates, they hadn't marked to market, the securities had downgraded in terms of their values. So it's all tied again to the big and overarching question on inflation. Carolina, how have you navigated this?
Yeah, it's interesting. To that point, it was a perfect storm because in 2020 and 21, where companies were doing big rounds, they had all this cash sitting on the balance sheet. And for European companies sitting on the balance sheet in the European banks, you were actually losing money, right? Because the interest rates were where they were, which caused many people to flock to banks like SVB that actually had nice interest rates. And so, you know, in many boards, we looked at treasury management, and the exercise was, of course, you know, where can we, you know, of course, diversify the capital, but also put capital places where it's also not losing value at the minimum. And so I think the triple whammy was a good example because it, of course, the cycle turned, and for those that didn't turn their attentions to this very quickly, they, of course, got caught out. And, of course, the younger companies are the companies that have the less mature finance teams, that don't have necessarily someone looking at treasury management and risk management, which a lot of the larger companies would, which was, of course, a sort of unfortunate confluence of circumstances.
And Eric, I know you have views on this, the access to capital, the access to funding, and we're seeing already evidence that loan requirements are becoming more restrictive, that there's less risk amongst the banking sector as they adjust to the crisis that is rippling across that sector. It is an impossible question, but to what extent and when do you think the tide is going to turn on the access to capital and the deep freeze that we're seeing?
It's a great question, Tom, and I'm so concerned about this question for two reasons. One is that I actually believe that maybe people who were in Silicon Valley Bank and either they had venture debt there, a line of credit, or they actually had their deposits, they're all safe at the moment. The point that we're always thinking about as venture capitalists is we're looking for the next thing. And so there's another company that's being started today in a garage in a kitchen, not having access to Silicon Valley Bank. The repercussions of this will continue on and on. The challenge of even starting a bank, what I find when we're trying to do an investment with a small company is that those companies can't even get a bank account. It takes them so long to find one, so they go to one of the challenger banks very, very quickly, and so, because they can set up an account. And Silicon Valley Bank was one of the banks that they would go to. Without that sort of ability, we're in a different sort of a situation, a different world. Whereas if you're an incumbent and you were pretty well financed and you had venture capital funding and you had it in a bank, those are all statuses that many organizations don't have. So being in Silicon Valley Bank and having those protected by some government or some other organization that bought you, that's one thing. Many of these organizations don't have access. And particularly when we look at women and people of color, although Silicon Valley Bank was much better than the average high street bank, it's not as if all of our investments are women and people of color, and the only exposure we had were to Silicon Valley Bank were banks that had already exited. The ones that we have in our current portfolio, none of them bank with Silicon Valley Bank, which is an interesting statement. I don't know what that says. And I don't know what that says about when things will turn around. And I don't predict that because I haven't answered your question at all. I like my questions, so I've answered that one. But instead, it is one of these challenges that I believe it has repercussions for years to come. And we will be contending with this for a long time. This is not temporary in my opinion.
Okay, repercussions for years to come. William, let me put you on the spot on this question then, because you brought up the jobs picture and you put it in a positive light, but we're talking about 30,000 jobs just at Amazon alone, 21,000 from Meta, 150,000 tech jobs since October alone. There's people hurting out there. When do you think the bloodletting, the cutting of jobs, when does that stop? When do we get to a point where the tech sector can take a breather and say, we've done enough on the jobs front?
Well, I still think it's quite positive, to be honest, because the biggest scarcity in the whole of tech was basically good software engineers. And there is now a pool of software engineers that's floating around looking for the next job. So they might set up their own thing in the kitchen, but if not, you can hire them a slightly less ludicrous options program than you did before. So again, I actually think it's quite healthy. So, inflation occurs because you have shortages of supply, and one of the biggest shortages of supply is engineers. It's not a shortage anymore.
Carolina, your portfolio companies, where do you think they are? Are you leaning on them still to cut headcount? Have they slimmed down enough? Do you expect more job cuts at a significant level? We've got a chart, Bloomberg chart, and the data there showing the uptick, the red line being the tech sector versus media, healthcare, food, financial services, and there's the steep jump that we've seen. What is your assessment?
The answer is it depends. Firstly, it really depended on the kind of business. So I think that businesses that were exposed to the consumer were much faster to cut because they could very clearly see that we might enter a recession, and therefore discretionary spend might go down, and we can't really predict the future, so let's control what we can't control. I think what we've seen now, probably in the second half of last year, is it's starting to hit enterprise businesses and software businesses. Lots of companies now looking at their procurement function and cutting all the software that they've bought for many years, and I think you're starting to see software companies bring their guidance down. And so that is probably sort of the next layer, I would say. And then it really depended on the entrepreneur. I sort of take it back. Some of the entrepreneurs that I think have been through cycles that ran leaner anyway were very fast to control what they could control, whereas others have wanted to keep spending in technology, in building value in the business, until, of course, they saw something happen. So it's a generic answer, but I think thus is the beauty of a portfolio. Is there's diversity in it.
Taavet, do European tech companies come out of this leaner, more match fit to take on their competitors, whether it's within this region or versus the US or Asia, China? Or are they going to get to the point where they rue the day, where they're cutting their headcount? Is there a risk of going too far, given that battle over talent that we talked about?
So I spend most of my time investing in early stage companies, and I think you have to be optimistic. You have to be an optimist when you do that as a living. And I look at all of this as opportunity. Even what we spoke about SVB as an opportunity for other people to step in. Go to Wise, the company I started. Any startup can open an account there. We don't discriminate based on color or sex. So I think there's this huge opportunity for everyone else to mop up all the opportunity left. If I think about the European startups, I think the opportunity is great. They've always been more leaner than their US counterparts. And maybe it's because lack of capital, lack of access to capital, like they've been less capitalized than US peers, and that makes them much stronger businesses. So of course, we've seen layoffs, and I would assume we're going to see more layoffs, but I actually think European companies are going to be much better positioned to survive in a world with less capital, because they've been brought up in the mindset of don't overspend, look for smart opportunities.
What should companies be doing in terms of prioritizing, reducing their cost cutting? And I'll get back to you, Taavet, on this, but maybe Carolina, you're nodding, so I'll start with you, and then we can bring it round the rest of the panel. When you come through and you draw up a list and you talk to your founders and you say, look, this is what you should be prioritizing. Is it creating efficiencies, automation, digitization, head cut counts? What should be the priority at this point?
So for us, everything has to come out of the strategy, right? Which really we rely heavily on the entrepreneurs, the management team, to tell us what are your 2 to 3 must-win battles, right? And let's align the organization completely behind those. And depending on what resources you need to invest into to get there, come the decisions to cut costs, right? I think obviously G&A is the pretty obvious one. I think a lot of companies, and in Europe as well, had become very bloated, because when money is cheap and you're growing very fast, the easiest thing to do is hire more people and throw money at problems. And so a lot of teams just don't have the muscle to think about efficiency, productivity, and come back. And so I think G&A is the universal one. I think as glass half full people and technology enthusiasts, we always feel that the last resort is cutting too much of R&D, because that is really your long-term competitive advantage. But sometimes you have to take a step back to grow stronger from that. And one of the things that I was thinking about, about 07, 08, et cetera, is I've never really seen an entrepreneur that has cut costs where it feels like it's the bone, and it hurts for a little bit, but then they always feel better afterwards, because you can always, pile it back on.
William?
Again, it's a less urgent situation for our companies, because they're not sort of on the edge of survival. Absolutely agree. R&D is the one thing they mustn't cut, and the really well-run ones will actually be pushing up the R&D spend, because you probably get more for your money at this point. Beyond that, these are big companies. They're very aware of costs. There's maybe not as much bloat in many of our businesses, the businesses we invest in, as there is in sort of some of the social networks and so on. So I'm not sure I'd have any great guidance for management.
Eric, where do you want to be swinging the knife? Or do you want to be raising prices? Do you want to be leaning on your founders to say, look, this is the time to put up prices?
Oh, well, in our portfolio, we have digital technology, health, education, lifestyle, media, and entertainment. That's where we focus in terms of sectors. The one that we have the biggest challenge with and where we really have to ask question is the cost of customer acquisition. So it's really marketing spend. And of course, it's a double-edged sword. If you cut your marketing spend such that you're not acquiring new customers, the question is, will you be able to then build in terms of your revenue, and so your top-line revenues? The problem is that we have gotten so used to spending so much money to get customers at any cost. And so we will run through thousands, tens of thousands, hundreds of thousands, if not millions, in order to acquire customers, which then often will churn. So we then ask you to focus on our portfolio, to focus on how do we continue to keep our customers, how do we increase their spend per customer, and so look at a different set of metrics around incumbent, and then think if we can transfer some of what would have otherwise been expenses associated with acquiring new, with maintaining and growing existing. And that's a bit of a shift for some organizations, which often means that we end up then looking at the marketing organization, looking at the people who are sitting there doing things that are, search engine optimization, all that. Those are places we think we can actually cut some. Data science, we don't cut.
Okay, not cutting data science. Taavet, you've invested as part of Plural and your platform in dozens, over 100 different startups. Some of those are in the hardware space in renewable energy. You touched on renewable energy, the transition. There's the input cost component there. How challenging has that been, adjusting to supply chains, material costs, input costs, those businesses that you've invested in, whether it's the battery storage business I'm thinking of? To what extent has that been a challenge?
I think for anyone who is dealing with physical goods, it has been challenging. You had the supply chain disruptions, you have the price hike. So I think that's put people in a difficult spot. A lot of it goes back to how well did you do with the previous fundraising. If you were raising the minimal amount possible, potentially if you're trying to be too greedy, too sensitive to dilution, like you just didn't get enough money, and now we're at a time where it hurts. I think same time, if you're looking at businesses who were well capitalized to raise money for 2 years ahead, say get over it. Hopefully you can make up for all of these things by charging higher prices.
Okay, let's lean into the opportunities then in this environment. It's all about inflation. So what about deflation? Is there an investment theme around deflation, whether it's digitization, creating efficiencies, automation, artificial intelligence, which one of you brought up earlier? Carolina, do you have a view on what the opportunities are around a deflationary play? Is that something you've been thinking about? Or?
Yeah, so we think about, I think inherently if you invest in technology, you believe in digitization, automation, move to the cloud, which are all things that create savings and drive efficiencies. If you look at our pipeline right now, we have a lot of companies in the software side that are mission critical software. So again, where can you acquire a customer and then have that customer be really sticky and drive efficiency and savings to the heart of the organization? We're looking at sectors that are really either not digitized or have huge opportunity, so healthcare, climate, those sort of big spaces, lots of work to do, and where even a marginal change has big impact. So we think about it from a sector lens, I would say.
And William, I know you've got views on generative AI, a lot of hype around ChatGPT and other platforms, but you think there's applications around healthcare applying generative AI, and I just wonder in terms of the efficiencies there, if that is something to look at.
Generative AI for healthcare.
Did I just come up with this?
I think you may have. I don't know. Maybe I said something that was misinterpreted. I'm sure.
Okay.
This stuff.
Artificial intelligence in terms of drug discovery.
Yes, so that clearly
which is very heavy R&D spend.
Absolutely, and it creates enormous spend on IT. So there's lots of brilliant companies that are doing exciting stuff with AI of all sorts of different types. The way that we look at it, that's not actually where you make any money, because those are the companies that are spending the money, and they're spending the money with the businesses that we own that are providing with the semiconductors, the hardware, the software, the IT services to create that, to run that, to link that up, to roll that into your business. So whatever you spend money on that's even vaguely technology related, in the end, the profits come to my companies. And it's a very small group, and they make all the money. And you guys are all very exciting, but my ones are the one that make the money.
Eric?
Wow. Okay.
Try to follow that.
Yeah, that is interesting. That's and probably very, very true. The only thing that I would add is that we do believe that there are some technologies. do we actually believe at ImpactX that what we're seeing in terms of OpenAI and chat are sort of transformative? Absolutely. We do believe these things are transformative. Do we think that they create some opportunities? We've been trying to run a few tests in the real world as to how they actually work. So we've been trying to have people do things that are considered cost savings. Can you actually create code from this? So how is your code generation going? So we were working with a group of CTOs about this question, asked them to sort of do something relatively simple. We found that they were able to get some savings at the very beginning of the process, but they found themselves somewhat hampered later on because they still had to go back and they still had to look through and they still had to sort of deconstruct what was actually going on. None of the things that we'd hoped could happen by generating pictures of bears, jumping around, by saying, I want to see a bear jump, and creating those sort of pictures. Does it then lead us to code that can actually then be embedded as scalable code within a solution? We were finding that harder to do. So for us, we certainly do look at AI, and we think of AI as being sort of applied, and sort of applied AI for consumer purposes to be an interesting space, and that there'll be some organizations that are doing the plumbing of AI that are going to do very, very well, obviously OpenAI and others. But the question as to, is it so transformative that it means that everyone else is knocked out of existence, that suddenly Google is irrelevant and therefore search and ad spending is irrelevant, and that this will be another way of doing things? We haven't been able to get to the conclusion that that is likely to happen in the short term. Incumbents are very hard to displace, and I'm not sure that there are a lot of competitive barriers. Once someone shows us how to do it with AI, I'm not sure that it's too difficult to then follow on with that and then say, because of our distribution network and others like Microsoft and others, that we're able to then copy, and then we don't find that there's much value as we thought in those original companies. That's just what we're finding at the moment.
And it's very expensive.
It is
expensive. So the computing power required is enormous. So you've almost got to create a new business model to pay for it.
Yeah.
Okay.
So
Taavet, let's bring you in.
I would add to this that if we're looking at, employment is still high, so everyone who has people-heavy businesses is actually in a pretty bad spot. Whether we're talking about healthcare, where we will find plenty of applications where we will be able to reduce headcount requirements by employing AI. And while the compute costs are high, they're much less than employing real human beings. And similarly, I think we can think of a lot of services sector. We can think about the legal profession. I think that if we look back 3 years from now, we'll see massive companies being built that are helping to solve these problems.
And lots of people out of work.
And people, whether it's lots of people out of work or actually just more productivity thanks to making use of AI.
Okay.
The problem is, there is still, think about hospitals. Can you find nurses? It's really hard to fill these jobs. So if you find even simple ways of increasing efficiency by 10%, these are going to be huge numbers.
But within that, not so much thinking about saving the headcount, but the delivery of drugs and the development of drugs, just the application of precision medicine completely transforms the economics of discovering, deploying, and actually then using drugs and other medical treatments. And that really, it must be the answer to one of society's biggest questions, which is how do we pay for healthcare costs, which are getting bigger and bigger and bigger? If we can completely transform the economics of developing and delivering treatments, and then get the right treatment to the right person and not use lots of things which aren't going to work on them, just because everyone's assumed to be the same. If you target your drug delivery on the people who genetically it will work on, you don't waste on the others, then that has enormous benefits to society and for the patients, so they get the right thing first. And the companies that are doing it make a huge amount of money. So that's got to be an enormous answer. And that's very much based on a lot of technology, a lot of artificial intelligence. So in the end, a lot of that money comes to us as well, but it helps everyone.
I'm going to try and... I love this theme, William. I
love it too.
It works. It's working for William. I'm going to try and pivot to a viewer question on the UK. And this question is phrased as, why is the UK, and you may dispute this, the way it's put, this question, why is the UK losing its crown as the tech centre of Europe? The Chancellor of the Exchequer, the Prime Minister want to make the UK the next Silicon Valley. Maybe they won't use Silicon Valley in the branding, but they certainly want to drive the tech sector. Healthcare is a central part of that. Is the UK losing its tech crown? Carolina? Eric? Eric, you've got views?
So I'm on the board of Tech Nation. So, tell me that I'm colored tech. when we look at sort of where are the areas that have produced, say, just use one metric of unicorn creation. So if you look at the world, there have been three places in the world that have produced over 100 unicorns. There's the US, there's China, and then there's the UK. So when you look at, and the UK is now about 130, 150 unicorns, when you look at those sorts of numbers, and that dwarfs what's present in other parts of Europe in terms of the number of unicorns that have been produced and decacorns that have been produced in Scandinavia, in Germany, in France, et cetera. So the question of have we lost the sheen of UK tech, and that UK tech is not producing in the way that it once did? I don't see the evidence of that. We're getting ready to publish the Tech Nation report tomorrow, in fact, that's going to be talking about how, in fact, this has been another banner sort of a period for tech creation in the UK. So I don't exactly understand that question. I don't know where it's coming from. What are the data points? So if I understood the data points, I might be able to answer better.
Okay, just briefly, Carolina, Taavet, and I just want to get to a quick poll before we end. Carolina.
Yeah, and actually I think Taavet might be much better positioned to answer this, having lived through it. But I think what I'd like to see, that I do think is an increasing challenge in the UK for technology companies, is the IPO market, where I think other parts of Europe are really gaining ground and have a very deep pool of investors who understand tech companies maybe IPOing not at the mature profit margins that they may be one day, that don't necessarily have such abrupt sell-offs. So I think that would be something that personally I would like to see get better for technology companies.
And Taavet?
So when it comes to company creation, early and mid-stage companies, I'm not sure I've seen the data to say that London is losing its position. But overall, I think I'd be rooting for all of Europe, but I think London is at a very good position, and as long as London keeps on attracting talent, I think this will continue. When it comes to the IPO market, I'm not sure I see any other European exchange besides London, but I'm also not sure that I see a very bright future ahead for the London Stock Exchange.
Yeah, the London Stock Exchange
it's a very tricky decision. Why would you list here?
We have a poll up. I'm just looping back to the top of our conversation, which is about the Federal Reserve, or about interest rates.
Yep.
And the question really in this kind of capital constrained environment, do we get to the point where we have to see a cut in interest rates for that funding environment to improve? The tech funding deep freeze won't end until interest rates are cut, and so that is up now. You're all voting on it, so we'll see. False. Okay, pretty strong views coming through on the dependency or not for central banks to cut interest rates. Finally, do you have a view on this? Is it more complicated than that? Can we live in a high interest environment? The likes of William's former employees at BlackRock think rates are going to be held for a pretty long time because it's going to get hard to get inflation back down to the central bank target. So we're going to have to live in a higher interest rate environment for longer. Can the capital requirements, can liquidity come back to the tech sector in that environment? I
certainly think so. And I think there's, I'm from Brazil originally, so I'm very familiar with inflation and high interest rates. And I think great companies can come from that, can experience great success. You need to operate differently. You need to think about the capital markets differently. But I do think that it can be quite healthy as well in the way that the capital flows and the way that people operate their businesses. And the data does show that actually some of the biggest technology companies, and I think Wise might be an example of this, came out of times of great disruption, of hard times. And so I'm actually, as an investor, very excited. Okay, before we let you go, any last one, anyone else who wants to chime in before we wrap it up on that point? No, we're all happy. We're happy. So that's the conclusion then. We don't need rate cuts before that funding environment can improve necessarily. Eric may have slightly different views, but I think
we like rate cuts, but I mean, if they don't happen, then we're going to have to live without them.
Elon Musk would like to see a 50 basis point cut later today from the Federal Reserve. We'll see if that comes through. You've all been absolutely insightful, fascinating conversation. Thank you very much for your time. We're ending there on a note of relative optimism in this kind of challenged environment amidst this banking crisis and record high inflation. There is still optimism from these leaders in the world of tech. So thank you all very much indeed. Well done. Thank you. Thank you. Thank you.
Please welcome to the stage Troy Asset Management founder and Chief Investment Officer Sebastian Lyon with Bloomberg's Merrin Somerset Webb.
Right, well, I don't need to do the introducing bit, but I do want to say that if you fall asleep during this, you don't have to worry because we are live recording the Merrin Talks Money podcast, so you'll be able to listen to it over and over and over again at your leisure later. Right, we're going to start. We've only got 25 minutes, so we're going to dive right in. Sebastian, thank you for being on my live recording of my podcast.
Pleasure, Merrin.
We're going to start with something that I read in one of your newsletters, okay? Markets are never constant. They change and evolve like the weather. Trends can sustain for months and years, perhaps even a decade, but not forever. Now, we're in the middle, I think you would agree, of a massive regime change for markets, from a world of low interest rates, low inflation, globalization, peace, low labor costs, cheap energy, all these wonderful things, to a period when all that has changed. Is that fair? Is that how you're looking at it?
It's very fair, and it means that it's going to make investing a lot tougher over the next 3 or 4 years, maybe the next decade, than it has been for the last decade. The last decade, you almost needed to just do very little. Buy and hold growth stocks. They were re-rated over a long, long period of time. There are very good companies in the UK and the US where you've seen steady growth, not spectacular growth, not like the tech companies that we were hearing about earlier, but just good, solid engineers, businesses that are growing 5, 10, 15% per annum. And they've been re-rated. They were re-rated hugely over the last decade. They went from 15 times earnings to 30 times earnings before COVID, even before COVID. We had the COVID blowout. They went to 50 times earnings. They're back now at about 30 times earnings. We're on a long journey back to that 15 times earnings where we were when interest rates were still zero back in 2012. Interest rates are now between 4 and 5%. If you look back at valuations when interest rates were 4 or 5% prior to the financial crisis, valuations were on those mid-teens multiples for good quality stocks. So I just think we have a long journey ahead. There's going to be more volatility, and that's what you need to be patient about in terms of from perspective of investing for private wealth, which is effectively what I'm doing.
Yeah, what you're doing is attempting to preserve our capital, right?
Yes.
So, but you've been positioned for inflation for quite a long time. So
yes.
Possibly too long.
Yeah.
Possibly too long.
Merrin.
Thank you for that. So you came into this latest bout of inflation ready for it.
Yes, pretty ready. I mean, I think that we were aware that there were huge concerns that interest rates were far too low, and that inflation was unlikely to remain stable. And the remarkable thing is that come 2 years ago, 2.5 years ago, 10-year yields got to as low as 0.5%. That sort of started a journey whereby the dominoes sort of effectively fell, and then we saw inflation remain stickier due to those post-COVID issues. And that sort of continued, and then obviously a year ago we had the war with Ukraine, which I think was a massive wake-up. Anybody who thought that inflation was going to be transitory, anybody thought that inflation was going to return to 2%, which markets were forecasting at that particular point in time, I think that was when everyone realised that interest rates needed to go up quickly, and inflation was likely to be around. And here we are, a year later, UK inflation at 10.4%. It's not going away.
But there are still people who think it is going away. There are still people who believe that once the impulse of higher energy prices and the supply problems of COVID disappear, we will go back to 2-3% inflation, interest rates will fall, and the old normal, or what we perceive as the old normal, will return, and then the panel before us will be happy because technology stocks will soar again. The everything bubble will return.
Yeah. I don't want to say it's Panglossian, but that's very optimistic. Of course, it's possible, but I think it's unlikely for all of the reasons that you gave in the original question. You've got deglobalization happening. You've got the power of labour, which is higher than it's been for many years, if not decades. And I think one of the things that I've always said about the expectation for higher inflation is wages. And it's always wages that you've got to look at ultimately. There's noise of commodity prices, there's the noise of the oil price, there's the noise of food prices.
But ultimately, the thing that sustains inflation over longer periods of time is wages. And we have actually been seeing wages rising materially. We've seen, obviously, strikes in the UK, but generally wage pressure as services have come back post the pandemic, particularly last year, we've seen a material amount of wage pressure. Now, maybe that won't be sustained.
But we can track it, can't we, by watching union membership? And one of the most interesting dynamics of the whole thing, I remember being told a couple of years ago that wage inflation could not be sustained because the unions weren't powerful enough. I'm thinking, you've got that the wrong way around. Union power follows inflation. Inflation doesn't follow union power. And we can see union membership rising and rising and rising, which may not be a bad thing, by the way.
No, not at all. But I think wages are key. Capital's had it, had a fantastic time for the last 2 decades, 3 decades, you could say. It's Labour's turn. And Labour is having its turn, certainly at the moment. We'll have to see how that lasts. But if that continues, then I would be more cautious about the view that you gave earlier about rates coming back down, inflation coming back down to normal. I think we're just in a world where things will be more volatile. Inflation will be more volatile. Inflation will come down. There's something called the base effect. Rishi Sunak knows about the base effect. He's not stupid. So that's why he's forecast inflation is likely to halve this year. Maybe it will, maybe it won't.
I don't think he was forecasting. He was saying that he would bring it down.
Yes.
Yes.
So single-handedly. But there is a base effect. And so unless something dramatic happens from a geopolitical perspective and the oil price doesn't go up to $150 or something, then inflation is likely to be falling this year. The question isn't whether it falls. The question is where it stops, and ultimately whether there's a sort of second wave out next year and the year beyond. And that will be the surprise to the investors who are saying things are going to come back down to where they were pre-COVID.
Yeah, so it feels like an environment where you would expect volatility at best.
Yeah.
Yeah. Okay, so rates rising.
Yeah.
Rates are not going to come back down to zero. This isn't going to happen. And in an environment where rates have basically been falling for a couple of decades plus, and then they start 4 decades, and they start to rise, things start to break.
Yeah.
Right? And we're beginning to see things break in the world of investment trusts. We're beginning to see some problems related to rising interest rates. We're seeing various bank problems, etc. What's going to break next? Where do you see the breaks coming?
I asked a colleague about this earlier. The usual suspects are European banks. They're usually one. Obviously, we've had Credit Suisse, but I suspect it will continue to be within the banking sector, or within sort of shadow banking type companies, perhaps that we've never heard of, like Greensill.
Yeah.
But those sort of issues will, I suspect, these dominoes will continue to fall. One of the things that I think there are parallels with what we're seeing at the moment from a stock market point of view with 2000 to 2003 and 2007 to 2009. So the financial crisis and the dot-com bubble busting. Both of those times, the S&P fell about 50%. And there, people say, well, is this a great financial crisis? No, it's not. The banking system is a lot better capitalized, particularly the larger banks are much better capitalized than they were when Lehman went bust. So there are differences, but there are similarities. And we've seen, a tech bust, effectively. And we've seen issues in the banking sector. And this time, they're related, whereas in 2000, the banking sector was fine. In 2000 and 2009, the tech sector was actually not too bad. Now we've actually effectively got them converging. So I think we need to think about the merging of those two bear markets and think that's probably what we're facing this time around.
Something significantly worse than we've seen.
Well, not necessarily worse, but probably, I think you need to be open-minded about how it's going to play out. But I think
when we say be open-minded, it means we don't know how it's going to play out.
Yes. No, we don't know how it's going to play out.
We don't have any clues.
But I suspect that there will be more accidents ahead because interest rates are still being tightened. The ECB raised rates by 50 basis points last week in the face of SVB. So clearly, the focus of central bankers is still on inflation, as it should be, looking at the UK today.
Okay. All right. One of the things that might break, of course, would be the UK housing market.
Your favourite topic.
My favourite. We've been talking about that for a long time. One day when rates rise enough, that will break.
Yeah. Well, there is, talking about domino effects, there is the effect, which I know you've spoken about on your podcast, I think, last week,
about fixed rate mortgages and the fact that these fixed rate mortgages are coming off gradually. We're not having the immediate impact of the 1990s downturn where interest rates went up from 7.5% to 15% within a space of a couple of years, and it was immediately very painful for people with mortgages. This time round, there's a slower effect of those interest rates effectively coming off, you know, the 2-year rates falling off and people obviously stepping up and having to take a 4% rate, for example, rather than a 2% rate. Yeah. So I think your UK property bear market, long loved, may take a little bit longer to come through. But I certainly think that, I mean, looking at the house builders, the share prices of house builders, which halved last year, that's telling you that you're looking at a pretty hard land. It's one of the reasons why we don't invest in house builders. That sort of thing can happen, and it can happen very quickly, and perhaps when you least expect it. So we will see on the UK house building front. Okay. After my prognostications in the past, I'm going to stay to on that one. And we don't invest there. So we don't invest in banks. We don't invest in house builders. So it's not actually something which will affect our portfolios particularly.
Okay. Well, let's talk about then where we can hide. Because in almost every other crisis in my career, anyway, there has been somewhere obvious, well, not necessarily immediately obvious, but somewhere you can hide, some area that's cheap, something that hasn't been caught up in the previous mania. And this time around, it's quite hard to see that thing.
It is incredibly hard to see that. And we have been talking about this in our investment reports for a number of years, in that we realised that when the debt bubble, when the bond bubble burst, the equity bubble will burst at the same time. And so, whereas in 2008 you could hide in fixed income, get out of the equity market, move into fixed income, move into dollars, you're fine. You were fine. In fact, you could actually make money in 2008 within that environment. In 2001, 2002, 2003, which when I started the Treasury Fund, when I started Troy, then there were some UK value stocks which were well capitalised, things like pub companies, well capitalised, generally good cash flows, good dividends. They've either been taken private or they've geared up a lot in the falling interest rate environment. So there aren't certainly the obvious places to hide within the equity market. Clearly, with bonds, it's tricky. I think short-dated bonds are fine, sort of 1-2 years. We put a lot of money during the now infamous mini-budget in September and October when rates spiked to over 4.5% in the UK. That was a wonderful opportunity to sort of just lock in 2-year money. But you're right, there aren't very obvious places to hide. The dollar was good last year. That really helped us last year. This year, I think the dollar's a harder one to call. Generally speaking, when there are risk-off markets, and if we're right about other accidents happening, then the dollar should do well within that. But I suppose I'd be surprised if we saw quite the sort of melt up in the dollar or melt down in sort of sterling that we saw back in September of last year. So there aren't very obvious places. I suppose the one that you'll probably want me to mention is gold.
I do want you to mention that. I was going to wait till the end, but you
which
just dive right in on that.
Has not been in a bubble.
Yep.
Did its job in 2020 during the pandemic for us when everything was melting down. Did its job for us last February during the invasion of Ukraine. And it was flat last year. And everybody looks at the dollar price, Marion. They don't look at prices in other currencies. We don't hedge our gold. So in sterling, gold was up 10% last year. You know, it did its job for us within the portfolio. It's made a new high in sterling last week. Was it early this week? Definitely last week during the Credit Suisse debacle. So I think that that still may yet do its job. It's certainly feeling that way. It's feeling as if it's not a bad place to be in an environment where inflation is high, where negative real rates are likely to stay in place. You are not going to see a situation where central banks are going to be able to put interest rates up well above the rate of inflation, which is what positive real rates are.
Because more things will break.
Because a lot more things will break. I mean, I think that was the real wake-up call of the LDI situation. That was the moment where people realised, policymakers realised, we cannot put rates up to 5% or 6% in the UK. Too many things will break. And so rates are probably going to stay higher for longer as a result. And there'll be some drift in terms of policy on
on inflation targeting. We've seen that with Haldane's article in the FT. We've seen it with Howard Davis at NatWest talking about thinks we should allow the inflation target from the Bank of England just to drift out maybe 3 years or 4 years, allow them to have a bit more time. That's slippage, effectively, within the inflation targeting.
Or move the 2% to 3%, etc. No one can remember why it was 2%.
Or move to a range from 2 to 4.
Yeah.
Whatever. And that is effectively debasement. And that is that's a good environment for gold. So I think gold will have a role to play.
And personal assets, for example, holds what in gold at the moment? It used to be kind of 10, 11%. Okay, so the percent of portfolio in gold hasn't actually gone up.
No, it hasn't gone up materially. No, it's been about 10 or 11% for a while. We wouldn't have it go up to about 15 or 20%. I think what's really important with holding gold and having a role within the portfolio is you want to have enough to make a difference. There's no point in having 1 or 2%. It's just not going to move the needle. But you also don't want to have too much where the tail wags the dog. Effectively, it's affecting the nav too much. You don't want to place your full bet there. But I think it has a role to play in terms of its defensibility, and you've seen it time and time again. Now three episodes in the last 3 years where it's kicked in, and it's actually kicked in very nicely at a time when things have been pretty febrile, and there were a lot of losses out there for elsewhere within portfolios and other portfolios.
Yeah. And how do you hold the gold? This is gold equities to a degree.
In personal assets, we hold it through an allocated account at JP Morgan, just like a bank account. And that's about 10%. And then we have 1.5–2% in a company called Franco-Nevada, which is a gold streaming and royalty business. We haven't got any direct mining exposure. I'm scarred from my previous gold mining investment experiences. The scars are on my back. So I like the idea of streaming because effectively they're far more in control of their own destiny in terms of the fact they've got hundreds of investments around the world that are continuing to, rather like an investment trust, really a diversified portfolio of royalties coming in, week out. And if one mine doesn't work, it doesn't really matter. Whereas if you're a miner, you'll tend to have only 4 or 5 mines. If one goes wrong, then production issues can be a real problem. So Franco-Nevada's been a core holding for about 5 or 6 years, and it's done very well for us.
Okay. I'm quite like to ask you about Bitcoin.
You can ask me about Bitcoin.
Okay, I'm going to ask you about Bitcoin. Is that another hedge against inflation?
I don't think so.
I mean, I think we know what I think.
Yeah.
But
no, I think crypto just, for me, goes into the too hard bucket. I think it's been found out a little bit. I was very interested to hear Niall Ferguson's comment about his view on crypto and the fact that crypto had been sort of effectively corrupted.
Yes.
We've never held it. I've never held it. I think gold has actually proven itself over the last year or 2 or 3 during a period where Bitcoin's been very highly volatile. And I think that sort of volatility is the definition of, people don't know how to value something. And it's about the most volatile thing that you can own. So clearly people don't really know how to value it.
This conversation, by the way, everybody, was in my last podcast with Niall Ferguson. We discussed this. Yeah. Okay, but let's move on from that. I'm interested in you saying that when I was talking about there being somewhere to hide, somewhere that wasn't caught up in the everything bubble, and you said no, previous times there have been good value stocks in the UK. A lot of my podcast guests say exactly that now. There is a place to hide, and it is the UK, which is cheap on any measure you could look at, and the value ratio between the UK and the US, for example, is that it's one of the widest it's ever been. And not only that, but these are good, high-quality companies operating internationally with good, high dividend yields. And I think you and I both agree that a good dividend yield is one of the greatest hedges you can get against inflation. So why on earth would an investor like you not be pouring into the UK market?
We're definitely looking at the UK market. In fact, I went to visit the headquarters of a UK company in Slough this morning. So we're definitely looking at UK companies. I would say, Marion, I'd say you're half right in that I'm not quite. I think you're comparing chalk and cheese a little bit in terms of comparing the US with the UK. If you scrape below the surface a little bit, the businesses within the UK, if you look at the FTSE, there are a large number of very large cap companies that are highly cyclical
We've got a very large percentage in oils. We've got mining. We've got utilities, large telcos exposure in Vodafone, BT. You've got a very large exposure to banks. You've got house builders. It is not like the US. And yes, there is a valuation differential, and I think there are some things to blame for that in terms of Brexit and other issues that you've discussed in the past. And definitely, investors, particularly in the UK, have been selling down in the UK. We can see that with the flows in unit trusts over the last 5 or 6 years. Wealth managers have been reducing their exposure to the UK stock market. One I happen to know is reduced from 30% of their portfolio down to about 3% of their portfolio, specifically in UK stocks. So you might say, well, there's nobody left to sell.
That is exactly what I was going to say. That if all the big domestic pension funds and all the big balance funds have shifted, which they have now, shifted their holding in UK equities down from 30, 40, in some cases 50%, to a maximum, in most cases, of 3 or 4%, they're done with the selling. It's over. So that may mark a bottom for the UK.
My one reservation is that all of those sectors that I mentioned, probably with the exception of sort of pharmaceuticals, a lot of those sectors are very cyclical. They did really well last year because we were in a cyclical upturn. If I'm right, and I suspect we're going into a hard landing, a more traditional hard landing than the ones we've had in the past as well. So by that I mean more traditional than the COVID recession, more traditional than perhaps the financial crisis recession, more like the recessions we used to have in the sort of early 90s that are sort of slightly more prolonged, central banks trying to tighten to get inflation down, slightly old school. Then those cyclical companies, like the miners, like the oils, like the banks, probably going to struggle. So they're going to really struggle with earnings, I suspect. So you may be right, but not yet. The other thing is looking at the kinds of companies...
Often right, but not yet. That's kind of standard.
Yeah. But I think that in terms of some companies that I mean, my largest holding is Unilever. Unilever is definitely on a discount to the likes of Procter & Gamble, Nestle, its peers, which we also hold, but not to the same extent. I think there is a little bit of a gap. It's not massive, but I think there is a little bit of a gap between those better quality blue chips within the UK and their international peers. I think that is a gap that has to narrow, and where we have been adding there. So I think that's my half-right bit.
There is a reason why lots of companies are thinking about moving their headquarters to America, and we know exactly why it is, just so they can get a higher share price, right?
Yeah, absolutely.
I interrupted you. Sorry.
No. I mean, I do think that the UK market has got a problem. I mean, they couldn't get Arm back. They've lost some great companies over the years, like Cadbury's, which we were a holder of. You know, there was no replacement for Cadbury's. It's now gone to Mondelez in the US. So I think that the sad thing is we have lost some great companies in the UK, and they haven't been replaced. And that is something which has been discussed ad nauseam for the last 5 or 6 years, and I'm sure you've written about it in your articles. But there doesn't seem to be a resolution to that. And the concern is that where we've got things like good companies like Ferguson, used to be called Wolseley in the UK, a large FTSE 100 company moving to the US. So I think that there is... I mean, it's not an easy decision. I saw that BAT was suggested by one of the shareholders that the BAT should do the same. It's got a very big US business. It hasn't got a UK business. So there is some logic to BAT moving to the US, and tobacco companies have slightly higher ratings in the US than they do in the UK. So we'll see whether they do. It's not an easy thing to do. It's not actually an easy thing just to get I worked at a company where they were getting a NASDAQ listing. They had a UK listing, but they wanted a NASDAQ listing for exactly the reason that you said. And I remember it was bureaucratically really tough. So you've got to be absolutely sure you're making the right decision. You've got to really think
your share price is going to double.
Yeah.
Yeah. Let's talk briefly, we haven't got much time left, sorry, about the rest of the portfolio. How much of it is in equities at the moment?
Low 20%. So it's basically the lowest it's been for about 15 years. Okay. Even lower than it was in the financial crisis. Partly coming back to the point that you said that there aren't obvious places to hide within this equity market. If there were, then we'd have a higher proportion in equities. But for exactly that reason, we're worried about that continued, not only multiple contraction this year, but also the fact that there's more earnings risk. And interest rate costs keep going up for companies. Companies have taken on, frankly, public companies have taken on too much debt. Debt levels have pretty much doubled over the last year in a lot of companies we've seen. Companies that were comfortable with 1 times net debt to EBITDA are suddenly comfortable with 2. Companies that were comfortable with 2 are comfortable with 4. And increased tax and increased increased interest costs mean that the earnings, the top line might be fine, but actually the bottom line, the earnings are not going to be as good. So that's why, because of those lack of places to hide, that's why we're very conservatively positioned at the moment, with the idea that probably within a year's time we'll be much more hopefully positively positioned. We're right.
Taavet, we have only got a few seconds left, so let me challenge you before we end. Give me one piece of good news.
I think that sometime in the next 18 months is going to be a very good time to buy the equity market. Just got to be patient.
How will we know?
How will we know? I think just keep an eye on valuations. I think valuations are going to... That's what I look at. I look at things like the CAPE. I look at things like the Q ratio. I look at the bottom-up stock picking, our bottom-up stock picking our stocks, and look at their valuations on a day-by-day basis. And that's what informs me as to whether I'm going to make those longer-term returns. So it'll be valuations which are the key.
All right, I'm going to call you every week for the next 18 months until you tell me it's time.
Okay.
All right. Sebastian, thank you very much.
Pleasure. I look forward to it.
Well, thank you all for joining Bloomberg Invest, Strategies for Wealth Creation. Our time is up, but you can continue the conversation on social media by following us on Bloomberg Live on Twitter and on LinkedIn. Search for the hashtag Bloomberg Invest. We hope you enjoyed those conversations. Thank you again to all of our speakers and moderators for a wonderful program. And most of all, thank you for being such an engaged audience. We really appreciate you being with us today. Please check our website, bloomberglive.com. We have, for our calendar of events, we have Bloomberg Wealth Asia Summit in Hong Kong on May 9th and Bloomberg Invest New York in June 7th and 8th. Do join us outside in the foyer for a networking reception now. I'm Elena Stevenson. Thank you for being with us.